Hi, I'm Matt Dicken, and this is Strategic Wealth. And here's what's coming up on today's show. All right, now what I want to talk with you about this week are bonds. And this week I want to talk with you a little bit about wills and trusts and really kind of estate planning in general.
Concern when it comes to their finances, and that's what?
Losing money. That's just a little bit of what you're going to see right now. Welcome once again. Thank you for tuning in. As usual, we have a ton of information we're going to share with you, so let's get it kicked off with this week's Money Minute. This week I want to share with you a story about someone that was living on a fixed income. And some of you watching right now might be in a similar situation. The individuals that I met with have retired about 10 or 15 years ago. And when they retired, they had both Social Security income and they'd set up a guaranteed monthly income out of their retirement accounts. Now, what had happened is time had gone by, and because of inflation, their monthly income that they were generating just wasn't going as far as it used to. So they came in and met with me. They kind of felt like there's nothing they could do. They just had to live on less money, and they were wanting to know if that was true or not. They wanted to see if they had any options. So we took a look at their accounts for them, and we wanted to see, are there any ways we can possibly increase the amount of money that their nest egg is generating? In reviewing their accounts, we found out that they were paying an enormous amount in fees. Unfortunately, these individuals were paying about $40,000 a year in fees. Absolutely outrageous. They were only generating from their accounts about $36,000 per year, or about $3,000 per month. So they were actually paying more in fees to the company and the advisors that were handling their accounts than they were generating themselves. So once we identified that, we found a way or a solution to reduce dramatically the amount of fees that they were paying each and every year. And therefore, we were able to increase the income that they were generating from their accounts by about $1,000 per month for their particular situation. Now, $1,000 per month for somebody that's living on a fixed income has provided a significant increase for them. They were very, very happy, and had they not met with us, they never would have seen the way that they could reduce their fees and therefore keep more money for themselves. So let me summarize it for you. These individuals, because we were able to reduce their fees, they were able to increase their monthly income from $3,000 to $4,000 per month. That's a difference between $36,000 a year in income to a little over $48,000 per year in income. So the message here is, even though you might find yourself on what you believe to be just a fixed income, sometimes there's things that can be done to increase how much money you get to spend and enjoy. And now let's talk about our Facebook poll. Do you have too much risk in your portfolio? Answer either yes, no, or I don't know, which is a common response that we get from individuals in the office when we ask them, do you feel like you're carrying more risk in your portfolio than what you should be? A lot of times individuals just aren't really sure, and we're curious what you think about your portfolio. And while you're on our Facebook page, you can take a look at any of our past radio shows, even some of our past TV shows where we've discussed things like the volatility of the stock market, taxes, inflation. We've covered the rule of 100 in the past. So if you've missed out on any of those, we have a link on the Facebook page which will take you to another website where you can listen to any of these great shows. And now it's time for X's and O's with Coach Matt. I'm going to head over to the whiteboard and cover with you some very valuable information. So let's go ahead and get that started. All right, now what I want to talk with you about this week are bonds. And the reason why I want to cover this information is because in this country today, there are over $1 trillion invested in bonds. Now, the reason why bonds have become so popular is individuals are frustrated with the volatility in the stock market, as well as the little bit of interest that they're getting maybe on their banking deposits, such as money market accounts or CDs. You know, CDs right now are probably paying somewhere around 1% interest. You know, if you have some older CDs, maybe they're still paying 3 or 4%, but as they mature, the interest rates are going much lower. And the problem with the CD right now is that 1% interest is before you factor in taxes, which of course are going to take a portion of your interest away, as well as inflation, which is probably going to be a bigger issue in the years to come than what it has been over the last few years. So as we take away taxes and inflation from the CD interest that we're earning, it really ends up being not very much. So individuals have looked for alternatives to CDs, and we've seen a lot of that money has gone into bonds because individuals are believing that bonds are completely safe. And basically, the way a bond works is it's just an IOU, kind of like a loan. You're going to loan your money maybe to a corporation or to a government entity. Now what they're going to do is they're going to pay you a certain amount of interest over a specified period of years. Could be a short period of time or a very long period of time, but they're going to pay you the interest, right now maybe 4, 5, possibly even 6%, until you hit the maturity. Now what the maturity is kind of similar to a CD, is that's basically at the end you get all of your money back, assuming that there isn't any type of a default or anything like that. So bonds have become very, very popular because individuals are looking for better returns than what they can get on their CDs, but they're concerned about the volatility of the stock market. Now, if we compare a bond to a stock market, basically when we invest money in a stock, what we're doing is we're betting that there's going to be some growth. So we're buying stocks because we believe we can buy them at a price, and over time we will watch them go up in value. That's basically what we're looking for. A bond, you really kind of buy it for a different reason. The reason why we'll put money into a bond is you're kind of betting that they will not go bankrupt. Okay, so they're going to be there over a specified period of time. So you're kind of betting that they will not go out of business and they're going to be able to give you all of your principal back. That's why we would purchase a bond. Now, when we invest money in bonds, there's really two different risks that you have associated when we put money into bonds. Now, this could be true whether you have one bond or 5 bonds or 10 bonds. There's a couple of risks that you have. We have a default risk. And what we're talking about when we mention default risk is we're basically concerned that the company or the entity or the government will actually go out of business. Now, the way that you can protect yourself from that is to invest in A-rated type of bonds that are out there. Bonds are typically rated A, B, C, or D, depending on the rating agency. So we want to go with an A-rated bond. That's one level of protection. Another thing that you can do to protect yourself is to use what's called revenue-backed bonds. Now, what a revenue-backed bond could be is typically going to be a municipal bond, some sort of government bond. And with a revenue-backed bond, that means that there's going to be some sort of taxing authority. So it could be like a sewer district or a school system, something of that nature. It's backed by revenues. A non-revenue-backed bond is something like maybe a tollway or possibly an arena project or a stadium project, something of that nature. There's no real guarantee they're going to be able to generate the revenue that they need to meet their debt obligations. So we have default risk, which means that the entity goes out of business and you don't get any money back. So a very real risk. Today, there's a larger risk or a bigger concern, and that is interest rate risk. So you have basically interest risk to be concerned with. And what we're talking about here is with bonds, what happens is when interest rates go higher, the value or the yield on your bond goes lower. Okay, so again, as interest rates go higher, your yield goes lower. If we were to basically try and graph that, if you remember when we were kids and we had basically a teeter-totter that we used to play on, it was kind of fun back when we were a child. It's not necessarily as fun when we start taking a look at our investments. But let's say that we have money invested in a bond, and let's say that we have interest rates over here, and we have yield over here. What happens is they work in coordination. So as interest rates go higher, then the value or the yield on your bond goes lower. And the same thing is true. If interest rates were to go lower, then the value or the yield on your bond will actually go higher. So what are we talking about here? Let's say that you have a bond that's paying 5% interest right now. If we take a look at where interest rates are in this country today, they're basically at historical lows. Okay, they're about as low as they've ever been. So they really can't go any lower. They can only go one direction, and that's going to be higher. So as interest rates rise, the yield or the value of your bond will go down. Now, why is that? Again, if you have a 5% bond right now and interest rates go up, maybe one day the CDs that we had up here earlier would be more attractive. So nobody's going to want your bond. You would be forced to sell it at a discount, or you'd be forced to holding it to maturity. And again, maturity could be a short time frame away or a very long period from now. So if you're going to have money in bonds, what's best is to use bonds that have a short maturity date, maybe within the next 2, 3, 4, possibly as far as 5 years. Because what happens is if interest rates go up, if you're going to get all of your money back in a few years, you're not going to be forced to sell it unless you absolutely have to have it for some reason. And again, if you hold it to your maturity, you get all of your money back. So having a short-term bond's not necessarily a bad thing to do right now. Now, one of the things I would definitely avoid at all costs is having your money in a bond fund. What a bond fund is just basically a collection of a lot of different bonds. You can have government bonds or corporate bonds, and a fund manager goes out and buys them. It's kind of like a stock mutual fund, but in this scenario, it's just a collection of bonds. And there's really two reasons why I would say avoid buying into a bond fund right now. Number one is you're just going to add an extra layer of fees. If you want to own bonds, then just go out and buy bonds. There's no reason to pay somebody an annual fee to manage the account. These are pretty simple to understand once you've got a basic education on them. So don't buy the bond fund because it's just going to come at a layer of extra fees, maybe 1 to 2% per year is what they're going to charge you to have that particular mutual fund, and that might be after some sort of a front-end sales load. So we want to avoid the fees. The second issue, and probably the bigger issue, is we've talked about interest rate risks. Now again, if you hold the bond to maturity, you get all of your money back. You're not forced to sell it at a discount. With a bond fund, there is no maturity. Okay, so on the funds, basically the way you need to look at that is it has 0 or no maturity date. No maturity date. It's a big reason why you want to avoid it. What happens in the bond fund is the fund manager is buying and selling different bonds. They're not ever holding them to maturity. And let's say that somebody needs their money back or they want their money back because they have to pay for retirement expenses or they want to buy a new car or a new home, something of that nature. The fund manager is then forced to sell the bonds in order to free up money to give to them. Now for every 1% increase, let's go over here. Let's say for every 1% increase in interest rates, which again, right now they're at historical lows. They can only go one direction, and that's up. They can't go lower. A bond will lose 8% on average. Okay, so for every 1% increase in interest rates, a bond or a bond fund will lose about 8% in value. So if we have a 2% increase in interest rates, say we go up 2%, then what's the correlating amount that the bond or the bond fund would lose? 16% in value on an investment that individuals really believe are safe. And in a lot of cases, they're not. The last time that we had an environment where interest rates were as low as they are today, once interest rates started to go up, individuals lost on average somewhere between 15 and 20%. So basically, bonds can be a safe alternative. You just got to make sure that you do not have bond funds, own individual bonds, and when you own those bonds, you want to make sure that they have a short maturity because we know one thing's for certain, eventually interest rates have to go higher than where they are today, and I think this is probably going to be the next area where individuals are going to lose significant sums of money. And now it's time for our tip of the week. And this week I want to talk with you a little bit about wills and trusts and really kind of estate planning in general. We always recommend that everybody at least have a will. Now, a lot of attorneys will recommend that you have both a will and a trust, and depending on your situation, that might make a lot of sense. But everybody needs to understand that they should have at least a will. Now let me talk a little bit about those that live in the state of Kentucky, because there's a little bit of differences between each of the 50 states. But if you're a resident of the state of Kentucky, one of the things that you have to understand is that you have a will. Every resident in the state of Kentucky has one of these. Now, even if you haven't completed the will yourself, what the state does is if you were to pass away, they provide you with their copy of a will. So every resident has one of these on file down in Frankfort. Now, you don't have to read this particular will, but if you would find all kinds of things that you would not be very happy with. Let me give you an example. A lot of individuals believe if it's a simple situation, they don't really need a will. If I pass away, money's going to go to my spouse or maybe my children, things of that nature. And in a lot of states, it works that way, but not typically here in Kentucky. The way the will works that the state of Kentucky provides you basically says that if you were to pass away, then your spouse gets half of your assets, but then there's a hierarchy that goes on to your brothers and sisters and parents before your surviving spouse would inherit the other half. Most people are shocked to find that out, and of course this isn't a situation that really anybody should be happy about. You can fix this problem by going to a certified attorney and getting your own will. Of course, that's going to trump the one that the state provides us. And while you're talking with that attorney, you can ask them, do you need a trust? Some individuals need them, others don't. But another thing that we recommend to everybody is to at least get a power of attorney and a living will. A power of attorney will give someone, either a friend or a relative, power to spend money on things if you were to become incapacitated, maybe in a hospital or some other event happens in your life where you can't get to maybe your checkbook or your legal documents. Someone else can step in and provide you care for those types of things. So that's always something that's important. But then also having a living will, and basically a living will spell out exactly what you want to have happen if, again, you can't answer for yourself. So would you want to remain on life support? Would you not want to remain on life support? It tells your friends and family exactly what you would want. Now, really, none of these topics are fun to talk about, but it is something that you need to review and update at least every 5 to 10 years, or when you have a life-changing event, such as maybe getting remarried or having a child, maybe moving from one state to the next. You need to make sure that you work with an attorney to get these things updated. So again, in our office, we are not attorneys. We can refer you to an attorney that can help you with these things if you don't already know one, but we do recommend that everybody, especially in the state of Kentucky, to at least make sure that you have an up-to-date will. So that's this week's tip. On a previous radio show, we talked about the importance of having safety and security as you get closer and into retirement. So let's take a look at that.
All right, Kentuckiana, welcome back to the show right now. Matt, we're taking on a topic that I know that polls have been done, and the stat is 97% of Americans, this is their single biggest concern when it comes to their finances, and that's what?
Losing money.
Absolutely. Yeah. And you know what? We get more emails in here about what can I do to be safe? How do I keep everything safe? In this crazy market that's happening right now, I throw it over to you. What can people do today to be safe?
Well, let's first talk a little bit about why it's so important to be safe with your money, especially as you move closer and into retirement. We mention all the time that you get one shot at getting your retirement planning done right. There's no reset button. There's no do-over. So it's incredibly important that you do not invest your money, is really once you're within about 10 years of retiring, in things that are overly aggressive or in things that if they were to go down in value, you'd maybe have to delay your retirement, or even worse, possibly have to go back to work once you've fully retired. So safety and security kind of has to become key and has to be paramount. You don't have the time to make up for market drops like you may have had when you were back in your 20s, 30s, even in your 40s. Once you get into your 50s, 60s, certainly into your 70s, you just don't have the time to make up for significant market drops like we've seen in the past, and we will certainly be seeing again in the future.
Matt, so many of these emails come in, and they're essentially saying, I can't sleep at night. They're so concerned, and they may not be getting the type of advice from their advisor that will allow them to sleep at night. They're getting the same old, sit it out, it's going to change, things will get better. I mean, what do you say to that?
Yeah, well, you have to have a shift in your strategy. As you move closer and into retirement, safety with your money needs to become more of a priority. A lot of our clients that we work with will tell me, they'll say, Matt, I'm not as concerned about the return on my money as I am about the return of my money.
Right.
I just don't want to lose anything that I have. So there are still safer types of investments that you can invest in today that will give you a reasonable rate of return. And we define reasonable to mean that you really need to have returns of somewhere between, say, 6 and maybe 10%. That will allow someone to take a withdrawal from their account while they're retired and still leave some money back in the account to keep up and counteract inflation, which over a 10 or 15 or 20-year retirement will have a dramatic impact. So if you never lose any money in the first place, it's easier to get a reasonable rate of return because we've talked about it here on the show in the past. When you lose money, it's very difficult to get ahead and stay ahead. If you have an account that goes down in value by 50% in 1 year and up 50% the next year, you're not back to even.
You are not back to even.
You need a 100% return to recover from that type of drop. And that takes a long time. On average, when we lose money in the stock market, it takes on average 7 years to fully get back to even. And what ends up happening is you lose all of that time. You have inflation, you have taxes, you have fees that can kind of compound and make the problem even worse. So if you never lose money, then you don't have to take the risk that's necessary to dig your way out of a hole because you never lost anything. You're not trying to get back to even, taking a lot of risk trying to make up for lost time. If you never lost it in the first place, it's much easier to have a successful retirement.
Matt, I see it when you do your seminars. You say exactly that. And I see those people in the audience, and they're skeptical. They're like, oh, no, my CD only gives me 1%. That's the only thing out there that is guaranteed and safe. And it's not. There are alternatives.
Yeah, there are certainly different alternatives that are out there. We, as a firm, specialize in safer money options. So sometimes individuals will say, well, Matt, why hasn't my advisor brought up these ideas to me? And it might just be that they don't know anything about them or they don't know a lot about them because they're not safer money focused. They're more of a risk-based type of advisor, and that can be appropriate for someone that's younger or someone that wants to be aggressive with their money. But as you get closer and into retirement, you need to find ways to take less risk, but still see it grow at a reasonable rate, and that's where we specialize, and that's where we come in and can provide advice. So it could be possibly different preferred stocks or different ETFs, maybe CDs in a higher interest rate environment than what we're in right now. It could be different types of bonds or fixed or index annuities. We do a lot of work in our office with index annuities, and they have income riders that are available today that for a small fee and for agreeing to a certain amount of time before you take all of your money out of the account, you can guarantee yourself maybe 4, 5, 6, in some cases as much as 8% guaranteed interest in a safe environment. And like I said earlier, when you never lose money, Mark, it's a lot easier to get ahead and stay ahead. Basically, what I have is a chart. We could provide this chart to anybody that would like to request it. But we went back and we took a look at the stock market over the last 20 years. And we showed with the volatility and maybe someone paying some fees along the way, if they started out 20 years ago with $100,000, at the end of last year, they would probably have about $204,000. So, not bad. They more than doubled their money. It took 20 years, so that's kind of a long time, but they more than doubled their money. But what if they had never lost any money in the first place? If you go back and you can eliminate the negatives, maybe limit what the growth could be on the good years, which is kind of how an index annuity works, then the same person starting 20 years ago with a $100,000 investment could potentially have over $600,000 today had they never lost any money. So that's the power of never losing money. We usually advocate in our office for kind of the tortoise and the hare analogy. It's getting there with consistency is what will win the race, not these wild gyrations like we've seen in the stock market over the last 20 years.
You bring two things to mind again that we hear about all the time, and one is, what is safety? But I think the more important one is you have a lot of people that feel that they're safe because I have 20% of my money in a safer option. And there is something called the rule of 100, Matt. You talk about it all the time as a good rule of thumb, especially if you are close to retirement or somewhat into retirement. Why don't you tell our listeners about that?
Yeah, well, a lot of times we'll see individuals are doing the exact opposite of what they should be when it comes to safety in their money. What the rule of 100 says is basically whatever your age is, that's the percentage of your retirement assets that you should have in a safe place, meaning you can't lose any money on it. And then the difference between your age and the number 100 is how much you could potentially put at risk. So if somebody is 60 years old, then that means that 60% of their retirement assets should be completely safe where they won't lose anything. And if they're comfortable with it, they could take risk with the other 40%.
Completely safe.
Completely safe.
Talk about completely safe for a moment. Because I think, and you've told me this, you've had people, appointments coming in to see you at your firm who feel that they're in a completely safe environment. And the fact of the matter is, Matt, they're not.
Right. Yeah. It's completely safe means you can't lose any money at all, period. We see individuals that will say, well, my money is safe because I've got a diversified mutual fund portfolio. And as we've seen in the past, September 11th, 2008. Just because you've got a diversified mutual fund portfolio doesn't necessarily mean that your money is going to be safe. Now, because you're diversified, you might not lose as much as you would had if you just put all your eggs in one basket, but it certainly doesn't guarantee safety. So what you need to do is have some sort of an investment. It should be, you should adhere to the rule of 100. You need to have some sort of an investment that has a guaranteed safety net, some sort of guaranteed mechanism that will prevent it from going down in value. And there's different strategies and different ways of accomplishing that.
All right, folks, stick around. We got a lot of great stuff to come today. You're listening to The Matt Dicken Show, where safe money is smart money.
And once again, it brings us to the end of another wonderful show. Now, if you've missed anything in this week's show, or you'd like to see previous shows, you can see them on our website. And keep in mind, retirement planning is a journey, not a destination. We'll see you here next week. I was born and raised right here in Louisville, Kentucky. Started in the industry in 1997, and I started Strategic Wealth Designers, my firm, which is an independent firm, back in 2002. From a very young age, I always knew that this is what I wanted to do. I really was interested in being in a career where I could really help people, and then I kind of had a knack for money. It just kind of became a natural progression that I would help individuals with their investments and their retirement planning, goals and dreams. So it's just something that I always knew that I wanted to do. Well, I love what I do. I don't consider it work. Every day I get to help somebody new typically. I love helping people and solving problems, and I get to do that basically on a daily basis. I kind of view what we do for a living, or what I do for a living, is one of the most important jobs somebody can have. And it's a lot of fun helping somebody that is maybe 4 or 5 years from retirement and taking them all the way through until they're officially retired and enjoying it, and doing the traveling and doing the hobbies and passions that they had always hoped to pursue. That's the most rewarding thing that we get to do over the course of the year. We're going to continue to help as many people as we can in the community. We've built our dream home here. The business is located here. Our friends are here. Our family is here. Our clients are here. We don't ever see ourselves leaving, and I really enjoy what I do for a living. At this point, we're not necessarily working because we have to. I got started at a really early age. I've been fortunate. I wouldn't have to do all the things that I do, but I want to continue to do the things that we do, like the radio show, the TV show, and the educational classes, because we want to help as many people as we can have a secure, successful retirement, and I'm going to do it for as many years as I can moving forward.